Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Andrew Maguire. Andrew sits on the advisory board of the Allocated Bullion Exchange and is a consultant and advisor to many international hedge fund managers, bullion banks, directors, metal traders globally, all of whom rely on his highly recognized field of expert market analysis and incredibly accurate ability to forecast. And Andrew has been with us before. I'm really glad he can come back with us again today because I think he's going to help us understand what's going on, what the impact of Basel III rules might be, and also to talk to him a little bit about a project that he's been putting together over the last number of years to try to help to gain real honest price discovery in precious metals. We know, and Andrew knows better than anybody, how the paper markets destroy price discovery in the honest-to-goodness bullion markets. Thank you for joining me again, Andrew.
Oh, Jay, it's been great to be with you again.
It's really good to have you. I suppose you're talking to me from London right now, or somewhere over there across the pond?
Yeah, that's right. It's pitch black, and
pitch black. Well, it would be at this time of the night. All right, so Basel III rules for bank reserves, and you know, as I understand it, and this is why we have you on, I want a better explanation. I want our listeners to understand gold will become a tier 1 asset valued at 100% for banks. I think it will be valued equally with cash and with sovereign debt instruments. Do I have that right?
Yeah, and I think it's really important to drill down into this a little bit because, you know, when you realize the scale of this, because we're talking about the really gold and silver trading as foreign exchange crosses here. So it's, you know, we tend to, in the US, we tend to look at the COMEX, the paper markets, the futures markets. Reason being is because actually most all but accredited CTAs, and in fact, even not many of those are even allowed to trade for the foreign exchange version of physical gold and silver. And so really, U.S. citizens tend to think of the COMEX as the price setter. Well, it's just not. And I think, yes, it's had control. It's all about position concentration. And maybe if there's time today, but if not, maybe we should come back and talk about that. And even we had a recent interview in December with Bart Chilton, ex-commissioner of the CFTC,
yes,
who absolutely affirmed. I worked with Bart during his tenure at the CFTC, but during that interview, he actually affirmed what we all guessed and all had empirical evidence of, which was that JP Morgan got a free pass when they took over Bear Stearns and were provided a position concentration position that was, as he put it, went on far too long. But I mean, I think really, as you say, let's talk about Basel III, the effect that going to have on the price of gold.
Right. Please. So as I understand it now, banks. Which banks does this apply to? Does it apply to American banks? Does it apply to European banks? The Basel III rules.
Same actors. We're talking about the too big to fail, and we're all on the hook here because these are the taxpayer insured banks that we know when they fail, we bail them out, and when they win, they privatize the profits. So anyway, let's just look at these. Part of the reason that this Basel III rules came into play was because of the concerns about the too big to fail banks and the kind of risks classifications. So as you said, Basel III rules will formally reclassify physical gold as a cash equivalent. Mm-hmm. Now, what that means, Jay, is that the largest form of gold traded on a daily basis is in London, is paper gold, or as it's called here, unallocated gold and silver. Now, as of Monday, unallocated gold will no longer be treated as a cash equivalent. So this has massive implications for the price of gold. Although informally accepted by some bullion banks since 2018, in Canada and one or two places. But before Basel III, there was little distinction between unallocated and allocated gold holdings. Now, unallocated gold has to date served as a weighted interbank cash collateral. Now, the over 600 tons of unallocated gold and the over 5,000 tons of unallocated silver that are cleared between a daisy chain of London Bullion Market Association bullion banks every day, may I add, and that is in comparison to the only 3 to 5 tons of physical that ever really transacts.
Wow.
Now, so really we're talking about, this is what's going to directly be affected by these new rules, is this difference, a massive amount of money floating around being cleared between these banks that really has, we now will be affected by these rules. Now, clearly, the volume of gold and silver traded every day are not physically backed. Now, they constitute ledger entries settled daily between a cartel of bullion banks, and they agree to cash settle the gold and silver trades among themselves. And when we talk about, I'll just briefly say, there are times, Jay, when we have seen 50,000 tons of silver trade in a 48-hour period. It's so ludicrous. So anyone who says, well, I'm a bit skeptical, maybe it is backed, implausible. Implausible.
Yeah. Right. So 50,000 tons of paper silver.
Yeah, paper silver. We're talking about, I think, how many miles long? I think that would probably be 7 mile longs of Brinks trucks lined up in a row. It's just ludicrous. So as a wholesaler, it's a joke, but we're very sympathetic towards the poor producers who are being affected by this.
Sure. Andrew, let me stop you. Let me stop you just for a minute then. So you're talking about all of this paper, gold, and silver. Now, when Basel III goes into effect, the banks can't count their paper values any longer. They're going to have to just count physical values. Do I have that right?
You're getting right into it. Absolutely. And so we let's look at that leverage. What is that leverage? So people can start to do their own sums here. We've got empirical evidence. That's 2010 Reserve Bank of India report that's published. That verified a paper-to-physical trade ratio of 92 ounces of gold traded for every ounce of physical. Yeah. However, these estimates do not include billions of dollars of bilateral derivative bets, which likely brings this ratio closer to 1,000 to 1, and that's no exaggeration. This has been an undelivery market for so long, and these levels have accrued over time. Now, let's not forget that unlike any other form of commodity such as oil, grain, etc., and people don't think of it in this way, gold and silver are actually trading on the global foreign exchange markets as a cash pairs trade. That meaning that, and cash is the operative word here, and this is what you're getting to, you're drilling down to, is it has to be cash. Now, but if it's not cash, that's a problem. And of course, this forms a very important component of a 5 trillion a day foreign exchange market, where, if I'm long the euro or the yen versus the dollar, well, it's cash. So one side is cash, the other side is cash, not an issue. But if I'm short cash gold or against the dollar, that means I have to have that gold in case I needed to deliver it. So under these new rules, under Basel III rules, unless the clearing banks can demonstrate that the short sale component of a foreign exchange pairs trade is backed by a cash equivalent, and when it comes to trading a first-tier gold asset, it then becomes a deliverable. This is the important part, that a deliverable component of a short gold, long dollar FX trade. And let's talk dollar here. It could be euro, it could be any other currency, it could be a Venezuelan currency. But so unlike before these rules, unless the bank or trading house selling gold for dollars has the bullion available for physically delivery, and I'm talking about auditably available, much like the SGE would be or the other physical exchanges around the world. You have to have the physical bullion deposited before you can sell it. So they're going to need to demonstrate this. And to be honest, they'll be non-compliant and in default of these new Basel III rules,
right?
Which is going to expose this daisy chain. And I think we talked about it. This is taxpayer-insured LBMA clearing banks, and they're going to be exposed to unacceptable counterparty risk.
Well, won't they be given some time to comply with this? And does this mean then that these banks are going to have to, if they don't have the gold, they have to get the cash? They have to have one of those assets or another, right? I think sovereign debt instruments count as well. So is it a matter of exchanging? Like when this goes into effect, all of a sudden, all that gold, that paper gold that they claim to be gold, it's not going to be there, right? Because they're going to have physical gold. So, I mean, are we looking at a potential crisis near term as a result of this? Or are the banks going to be given enough time to acquire the gold or whatever they need to comply?
Yeah, I think that you've nailed it. There has to be a phase-in period for some institution to comply, but it cannot be tolerated for the taxpayer-insured too-big-to-fail banks to which these Basel III rules are actually being targeted at. Now, obviously, let's not forget what happened in 2008, and Bank of International Settlements, being a central bank of central bank, is now trying to play this out so that they've actually warned the industry that something has to give here. So, yeah, there's going to be a phase-in period. I'm not talking about major drama on Monday, but nevertheless, look, here's what's happened. These guys, these actors already know what's coming down the pike, and that's why these privileged insiders, and I'm talking about, these are the banks that have, primarily the banks that have gold accounts at the Bank of England, the Goldmans, JP Morgan, HSBC, Scotiabank, UBS, Standard Bank, Deutsche Bank even, have for the last 18 months been stealthily accruing physical gold and silver for their own books. This is why. So, and we've been on record, I remember going on record publicly saying that, hey, this is 18 months ago. Goldman are going long here. And we know that because we're in the wholesale business. We tend to see the footprints. We tend to see the flows. And, while everyone's got their eye on the paper market and watching these wash and rinse cycles, these same banks are using those wash and rinse cycles, using their concentrated positions to actually accrue physical.
Which is really something new for the banks, for the commercial banks, right? This is really something new. They used to be net shorts all the time.
And this is it. And that's the other thing. You look at the COT report, okay, this is just one side of an equation. And this is what boggles my mind, is that intelligent people look at this COT report and fail to even connect the dots that on the other side of that equation is the over-the-counter market, which is far larger than what happens on the COMEX. So, what good is one side of an equation? The other side of the equation is that these guys are actually going long in the over-the-counter markets to hedge their short positions on the COMEX, which tends to fuddle people's minds and say, well, look, hey, they're short. We're indoctrinated to know when they go short, we mustn't buy because we're going to get rinsed. So,
so the speculators are staying away.
Yeah, exactly. So, and then whenever we see the speculators go long, everyone's saying, that's it, they're going to get nailed. And sure enough, they get nailed. Every time they go the other side of the trade, they get nailed. We're talking about banks that never have a losing trading position. Yeah. So, but I think the important thing is, I know you were drilling down into this, so what about the officials managing the gold and silver FX crosses against the dollar? And although officials acknowledge central bank currency intervention and that these foreign exchange agreements exist, for example, managing yen against the dollar, et cetera, these are agreed. There are agreed parameters, and despite proof that the Bank of International Settlements, which is the central bank of all central banks, has an active gold trading desk, officials actually denied they're actually managing gold and silver FX crosses. Well, that's ludicrous. ludicrous. In other words, yes, we'll manage all the foreign exchange crosses except gold. So, I mean, we've got published LBMA data that confirms FX gold constitutes a 5 trillion a year component of all foreign exchange transactions. And again, we're not accounting for derivatives here. That's totaling closer to 15 to 18 trillion per annum. So really the question is, how is this going to play out? Because you've obviously got a management issue here, where you've got the agent banks, or the banks that have been acting, that have the privilege of having accounts at the Bank of England, and if they would obviously know when their situation was going to play out, they would be positioned correctly for it, if they would know that something was coming out for sale, or if that, so essentially these guys have been in a privileged position where they've been accruing this long position. So I think most of these banks are going to be very, very happy to see a higher price. Now, the Bank of International Settlements holds the book of accrued derivative bets, and we conservatively estimate this to exceed $1 trillion. And we know that it's a major problem, because at every mark-to-market, over-the-counter OPEX event, which tends to be the last trading day of each month, we evidence these officials' footprints appear. And how do we know they are officially sanctioned? Sell orders, it's the manner and form they appear, Jay. Rational traders do not choose the thinnest hours to place very large orders. Why would we? None of us wholesalers would be choosing a moment like that. And it's the manner and form they appear. Not only that, not only would a rational trader not choose the thinnest market hours, but under the increasing scrutiny of regulators, no single entity trader would dare exceed intraday position limits without a free pass to do so. So it's pretty clear. I mean, so even though we have a gold trading desk, we know they're intervening in the markets, we understand through the footprints and the manner in which it happens that this wash and rinse cycle that tends to come through at the end of each month, or within that month, is part of marking these enormous derivative bets to market. So the banks will be happy if we see a higher gold price, because their balance sheets will be expanding, right? And they'll be able to lend more money or to grow their business. Yeah, and that's exactly why, while this global scramble to allocate ensues, it's going to backwash into the synthetic markets. But again, it's the why is it any wonder the LBMA were forecasting $1,532 gold for 2019? Why Goldman is projecting $1,400 gold for 2019? These are not altruistic companies,
No. Not at all. All right. Well, it would seem to me that in some ways this issue of paper gold, of the price discovery denial occurring because of these paper markets, that this is one aspect that might correct that. I mean, to a certain extent, would we see the real physical gold price, or will the paper markets persist in playing these games and denying price discovery in spite of this Basel III ruling?
Well, I don't think that's possible now. I think these rules are in play, and really you cannot ignore the fact. I mean, let's face it, the banks have already been gearing up for this for 18 months. It's just flown under the radar for most people who, myopic look at the paper markets. But, this also comes, Jay, at a time when producers are planning to cut supply. And we're talking about some of the big boys by a massive 20%. And you can drill down into the October Toronto Dominion research, which came out last October, it was. And what they were talking about is that attributable global gold reserves have declined by 50% in the last 5 years.
Wow.
We know from a wholesale market perspective that is extremely conservative. And it means there's an incentive for producers to build up their gold reserves into tightening physical supply. So now we've got two things going on. We've got the need to allocate, and we've also got, Goldcorp, for example, they're not alone in saying they're going to cut, projecting 20% reserve growth this year. well, that means that around 20% less annual global production is going to come to market for sale from the big producers. So we move from a situation where we've got a rock and a hard place here, where almost all forward production, which was historically sold forward or hedged, to a situation, the inverse situation, where producers are building reserves for no other reason than to capitalize on higher prices.
Wow. Interesting.
So it's a perfect storm, really.
All right, Andrew, we're just about out of time now, and I want to get to what you've been working on for so many years, and the Kinesis project. Talk to us about how that works and how you hope to see that really overcome this price discovery issue, and how that might help, and how people can profit from it.
Right. Well, in a word, Gresham's law. Look, by attaching a yield to gold and silver bullion, an investor can weigh up this yield attached to gold and silver against all other asset classes. So by attaching a yield to any asset class, you increase the value of that asset.
Sure.
And this has massive implications for how gold is actually valued. Now, by digitizing one-to-one back physical gold and putting it on the trustless blockchain rails, gold becomes fungible in small enough units to use as an everyday currency. And that is what Kinesis has done. However, what differentiates Kinesis from every other gold-backed currency is that when spent, Kinesis generates the user or minter a yield, or if you like, a share of the transaction fees. Now, it's really welcome to see other gold-backed currencies appear, as it draws attention to the merits of holding physical gold. However, none of these currencies solve the efficient means of exchange problem, which requires the necessary liquidity, nor do they defeat Gresham's law. So, in other words, in sync with Basel III rules, through Kinesis, we're about to witness the remonetizing of gold and silver for the masses. And it's welcome to see a multitude of gold-backed currencies appear, as it draws attention to the merits of holding physical gold. But I see limited adoption of these currencies, as none of the gold currencies defeat Gresham's law. And unless I'm incentivized to use my physical gold holdings as a currency, why would I spend it, Jay? I would rather save my gold and spend my depreciating, useless fiat currency first, and hold on to my precious gold as savings. So only by attaching a yield to gold and silver, I may add, can I be incentivized to use it as a payment system. And I see Kinesis as the trigger for a revolution in how money transacts. But from the perspective of seasoned gold and silver investors and traders, Kinesis provides the key to leveling the playing field altogether. And that's the reason why I'm supporting the launch of Kinesis, the Kinesis monetary system. It puts the power of gold and silver position concentration back in the hands of us, the people. Literally billions of dollars of physical gold and silver is required to monetize this Kinesis currency, which utilizes the well-proven institutional-grade allocated bullion exchange physical gold and silver platform that you mentioned earlier. All
right, Andrew. Where do people go to pick up on this and to follow up on it?
If I can send you a link, it's kinesis.money, and you can find out everything you need to know about Kinesis and how that is going to solve the broken banking system.
Yeah, it's Kinesis.
Correct. .money.
.money. Excellent. Well, thank you very much, Andrew, for being with us again. It's always a pleasure having you, and I hope we can do it again sometime soon to keep up with these fast-changing events in the monetary system.